Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are working on the assigned homework problems from the digital study guide that are related to Chapter 8, the exercises, the Group B exercises. Okay. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that's a whole other thing. Watching a problem worked out will not help if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. Right, so we're working on problem 35. Errors in accounting for long-term assets. Right, assume that on January 1st of year one, Middleton Company purchased equipment at a cost of $470,000. So January 1st of year one. All right. Management expects the equipment to remain in service for 5 years with a zero residual value. Middleton Company uses straight line depreciation. Through an accounting error, Middleton accidentally expensed the entire cost of the equipment at the time of purchase. And so prepare a schedule to show the overstatement or understatement in the following items at the end of each year over the 5-year life of the equipment. So equipment net and net income. Okay. Okay, so let's see here. All right, so we're going to have the year. That's going to be 1, 2, 3, 4, and 5. And then we're going to have a cost, which our cost is $470,000. Okay, so that's going to be the same for each year. Okay, so our accumulated depreciation. Right, so and then we need an equipment net. Okay, and the equipment net is what should have appeared, what should have been on the income statement. Because remember, it's saying that we accidentally expensed the entire cost of the equipment. So nothing was, no account was created on our balance sheet for the asset, right? So equipment net is going to be basically cost less accumulated depreciation to give us our equipment net, which are our book value, right? So calling it equipment net, I could call that the book value, right? And then of course, for our net income, which is on our income statement, right? We want to show how much should have been on our income statement and whether it is, I'm going to use U for understated and O for overstated. Okay, so if I have to figure out the accumulated depreciation per year, because we're using straight lines, so we have 470,000 divided by 5 years. Since there's no residual value, all right, that gives us 94,000 per year. So our accumulated depreciation at year one should be 94,000. Double that, 118. Add 94 to that, 282. Add 94 to that, 376, and 470,000. Okay. Now, as far as our book value on our balance sheet is concerned, right? Our net here should have been 470 less 94, or 376,000. Oops. Okay. And on our balance sheet, that is understated because we didn't put anything on our books as far as our asset is concerned. Okay, meaning if we put 0 on there, so if we call the asset equipment, right? Well, on our, and what I'm doing here is I'm representing this as my balance sheet. Okay, so if I have equipment less accumulated depreciation, right? So our equipment is 0 and our accumulated depreciation is 0. Okay, well, the reality is I should have had 470,000, okay, and 94,000 at my first year. Okay, so 0 is less, so that means it's understated. Okay, so quite frankly, all of these, since we didn't have any balance sheet accounts because we expensed the entire amount right off the bat, each and every year is going to be understated on our balance sheet, right? And basically all we're doing here is just creating a schedule of depreciation for the asset. This is straight line depreciation. We all know how to do this. So if I have 470 less 118, this is 282. 470 less 282 is 118,000. And that should be 94,000. Whoops. And then this here would be 0, okay, or correct, right? Right. So, realize that this is nothing more than doing, what we've done here is nothing more than creating doing straight line depreciation and creating a schedule and just determining, our effect on the balance sheet, which is something that we learned back in the math and in the chapter on depreciation for in the financial accounting, all right, for straight line depreciation. So if you're not getting this, go back and watch the theory videos. I'm not going to get into calculating straight line depreciation here. Okay, so with that said, now what about our net income? Okay, well, in the first year, I mean, and I'm going to use blue here, since this here is what our balance sheet looked like, our income statement, right, would have had depreciation expense, right? And if we put the entire 470,000 to depreciation expense, which was wrong, okay, then that means that it is let's see here. Okay, if this is if I had 470,000, okay, I should have only 94,000 of expense, okay? So what we're looking at here is we're looking at our net income. We're not looking at our depreciation expense account, okay? We're looking at net income. So what's our net income? Well, it's revenue less expenses gives us our profit or loss, okay? So if we have 470,000, okay, and we were only supposed to have 94,000, that means that we were 376,000 understated, right? All right, think of it like this, and this is why plugging in numbers is good, okay? Let me erase some of this to clean it up a little bit here. Okay, so if we had revenues of say 1 million, right? 1 million, and we had our depreciation expense of 470,000, that means we would have ended up with a profit of 530,000, okay? But the reality is that we should have had a revenue of 1 million, but only 94,000 in profit, okay? So that means we would have had $906,000, I mean, 94,000 of depreciation expense. So that means we should have had $906,000 in profit. Well, because we booked 470,000 as an expense, our profit is understated. It's less than what it should have been. So it's less by the 376,000 of profit for year one. Now, because it's entirely expensed, okay, that means each and every year after that, it would be zero, we'd have 1 million, okay, and we'd have zero for depreciation expense, so we'd have 1 million. Well, the reality is that we were supposed to expense the 94,000, okay? So now, because we expensed it, right, we're short 94,000 each and every year because of the depreciation expense that we should have taken. So that means our net income is overstated, right? We're supposed to have 906,000, but because we don't have any depreciation expense, we're showing profit of $1 million, right? If we had expensed 94,000 each and every year, well, then we would only have 906,000 in profit. So our profit, for our net income for years 2, 3, 4, 5 is overstated by the amount of that depreciation expense. Okay, so I realized that this here is a little bit complicated. Okay, pause the video, go back and rewatch it again if you missed something, you didn't understand it. Okay, but notice that what I did here was, I created a schedule. So I have my years, I have my cost, which stays the same each year because I paid 470,000. I had to calculate my depreciation, okay, and that gives me my they're calling it equipment net, or I call it the book value. Okay, so up until this point in time, up until here, right, this is nothing more than doing straight line depreciation, which you should know how to do. And of course this, I'm relating, I created this here, mimic the balance sheet so that I can understand whether I'm understated or overstated, because my books show that I had zero. Okay, my books show that I had zero because I expensed the entire amount. Right, so my book value of the equipment and accumulated depreciation is zero. So what I should have means that it's greater than, okay, the zero, having nothing on my books, except for, of course, the last year when I'm completely depreciated, then everything ends up being correct. Okay, so that's my effect on the balance sheet. But when it comes to the income statement, okay, we're thinking about the 470,000 that we expensed, okay, which gave us this amount of profit. Well, in year one, okay, I'm supposed to have this, right? But this is what I'm showing for year one. And of course, the difference between the two is 376, and it's understated because my expense is greater than what it should be. Then each and every following year, right, I don't have any expense. My expenses are zero, right? But they still should be, I should have the 94,000 in expenses. So the difference between each year is that, is an overstatement of my profit because I don't have the expense. All right. So that's a summary of it. And I know the screen looks a little messy, but like I said, go back and rewatch it again. If you don't understand straight line, go back and look at the theory videos. And this here is just another example of, if you understand the concepts and the relationships, okay, I'm explaining it because I understand it. But if you're missing this, where you don't see this relationship between the balance sheet and the income statement and how one number affects another number, then you definitely have to go back and restudy that, depreciation aspect. And if necessary, go back and watch the videos on the student community for an introduction to accounting and bookkeeping, which kind of gives you the framework for accounting and talks about the relationships between the various financial statements and the effect when you do something to one, you do something that has an effect in multiple places. Okay, you have to be able to think through that entire relationship, and you have to know that relationship, that framework. Okay. So with that said, that's it for this problem. And if after watching the videos and reading the textbook and you still have holes in your thinking, then feel free to contact an instructor and we'll try to plug up those leaks. Okay?